from our next two guests. Ed Yardeni of Yardeni Research and CNBC contributor Greg Branch of Veritas Financial, both with me live. Welcome back. Let's do this again, because we started this once and then we had a little banking crisis pop up, Ed, and it doesn't feel to me, from looking at your projections, like that swayed you at all. You still think we go 4,600 by the end of the year. Why?
Yeah. Well, what has swayed me is that the financial crisis that we've had here, this banking crisis, is going to be very well contained by both the Fed and the FDIC. And at the same time, I think it's going to keep the Fed from raising interest rates any further. I don't see the Fed lowering interest rates, but I think they are clearly now at a restrictive enough level where they don't have to keep raising interest rates. And meanwhile, the economy's been in a recession since the beginning of last year. It just happens to be a rolling recession, hitting different sectors at different times without adding up to an economy-wide recession. So I think, on balance, companies are going to continue to generate profit gains. I think we are going to see a decline on a year-over-year basis in the first quarter, maybe 5-7% for earnings. But from then on, I think we're going to see positive comparisons and probably something like up 10% on a year-over-year basis for the fourth quarter of this year.
You know, Greg, as Ed was talking, I wrote down two words: pause and put, both related to the Fed, because it sounds like Ed thinks both of those are back. They're going to pause, and the Fed put exists. If something happens, they're going to come riding to the rescue, as they always seem to do. What's wrong with that view?
Well, I agree with the pause part, obviously. I'm not going to be a hypocrite about this, Scott. You know, last year, one of my main complaints was that people wouldn't believe the Fed. When they said it's a 4% terminal rate and we're talking about a pivot, why don't you believe the Fed? So let's believe the Fed. I'll continue to believe the Fed and think that they only have another 25 basis points. The thing that the market is not getting is that the financial conditions in the system itself is going to pick up the momentum. And so the Fed does not need to continue to raise rates, because underwriting standards are going to increase. Credit is going to continue to tighten. And as my good friend Adam Parker said in the segment before, when credit conditions are tightening, you get slower growth. And so while my theme for 2022 was that I thought we were going to have a massive deceleration in earnings growth and top line growth that consensus was not taking into account, 2023 is the year of inversion, Scott. We're going to have a massive profit and earnings inversion. I think that you'll see company top lines come in rather significantly. And yes, consensus is now at -6 for the first quarter, but it started the quarter at slightly positive, and it's come down 6%. And we saw with the fourth quarter that consensus just isn't good at getting this right. We went into the fourth quarter with consensus thinking that it would be -3% earnings, and it turned out to be a -5 or 6% earnings. So I think that the market is still missing this. It's breathing a sigh of relief right now, but everything that the Fed did is going to start to impact. And we're going to see company profits and top line turn around, and we're going to see a more discriminating consumer, which is what Target and Walmart and others told us already.